Hi, and thanks for tuning in to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. Today, I'm speaking with Brian Jacobsen, Chief Economist with Annex Wealth Management. Brian, welcome to the show.
Thanks for having me.
So Brian, I wanted to start off by asking you about the stock market. We've seen the S&P 500 sell off as much as 10% from this summer's highs. Is that all because of bond yields?
It really does seem like it. Typically market corrections, so when we see a 10% decline to 20%, it's typically driven by fears of recession, fears of inflation, or fears of geopolitics. I think we have all of those coming together right now as far as, is the third quarter as good as what it gets for economic growth? Because now we're seeing bond yields move higher. Inflation, it's staying very volatile. And then, of course, there's the geopolitical issues that we don't know if that's going to spread to something a little bit wider, especially maybe affecting the oil markets more severely. The key thing is whether or not those fears become a reality. That's sort of what, in my mind, differentiates between a correction and a bear market, where you then get a 20% decline. Here at Annex, on our investment committee, we've been talking about it. A lot of these fears, we don't think they're going to go away, but we don't think they will become a reality, at least anytime soon.
Fair enough. And going back to the bond yields, Brian, rates on the 10-year and the 30-year Treasury bonds recently surpassed 5% for the first time in 16 years. Is that solely because of the higher for longer narrative with regard to the Fed funds rate, or is there more to it?
Well, I think that there's a little bit more to it than just the higher for longer. That's a contributing factor. I don't want to diminish that at all. But the big move up in bond yields really occurred at the end of July, after the Treasury announced that they were going to be issuing a lot more longer dated debt than a lot of people were expecting. So it really, I think, focused investors' attention on the size of deficits and then what's the trajectory ahead. Is there an actual plan to reduce the size of deficits to something a little bit more sustainable? So you do have the contributing factor of the Fed, higher for longer, but then also the Treasury issuance. I would also have to point out a third factor, which is that the growth numbers have been a lot better than expected. Sometimes what we end up seeing happen is that real yields, so the inflation adjusted component, those tend to go up when you get positive growth surprises. So that's a contributing factor. So if I had to rank them, though, I would say the biggest one is just the Treasury issuance. Second one is the Fed. And then the third one is the better than expected growth numbers that we saw.
Gotcha. And then some people have thrown out other explanations like deglobalization causing higher inflation over time. Some people have pointed to reduced foreign buying of treasuries. Do you put much stock into those explanations?
I definitely am sympathetic to them, but I don't attach a lot of significance to those explanations. Part of it is that deglobalization to me is more like re-globalization. It's a reorientation of supply chains. So, if it moves from China to Vietnam or to India, you're still going to have globalization taking place. It's just that it's perhaps going to be more with people who are politically aligned with us, as opposed to being perceived as a political adversary. And then the foreign demand for U.S. Treasuries has somewhat diminished. But when I look at the Treasury International Capital Account and some of the flow data as far as who's buying up all this debt, we have seen some of a reduction in the foreign demand, but not a lot. And in fact, actually, households and investment funds have really stepped in to fill that void. A bigger factor is probably the Fed stepping out of being this price insensitive buyer of debt. We know that they're doing their quantitative tightening. It would not surprise me if we see these rates move, say a 10-year Treasury getting above 5% on a persistent basis, that the Fed might actually consider stopping quantitative tightening, thinking that, they do need to step in a little bit in order to help support the Treasury market.
Well, Brian, we're going to have to leave it there. Thanks so much for taking the time to share your insights with us.
It's my pleasure. Thanks for having me.